And here he is. Okay. All right, perfect. Well, since our featured speaker has now arrived and it is 12:01 officially, we will get things started. Welcome, everyone. Thank you so much for attending MCF's inaugural advisor webinar. We are so excited for our speaker. We are excited to launch this series, and we are so grateful that you could join us. My name is Allison Helland. I am the Director of Donor and Advisor Engagement at MCF. I've been at MCF for about 2.5 years, and prior to that, I was an attorney in private practice focused on business, tax, and estate planning law. So it's a pleasure for me to be on this program with so many advisors. Before we jump in, I did want to just thank all of you for the work that you do on a daily basis to advance the conversation around charitable giving, both with your clients, with your colleagues, and with your communities. We understand you have a lot of demands on your schedule, and you are responsible for really walking clients through a variety of different things: income planning, tax planning, obviously incapacity planning, and the fact that you are willing and interested in also advancing the conversation about charitable giving is really inspiring. And we so appreciate the ability to really partner with you to help your clients reach their charitable giving goals. So thank you so much for being here today. As I mentioned, this webinar is the first in a series of 4. So we will have another one in May, then August, then October on a variety of different topics. Our goal with these is really to provide a forum to share some of the work we're doing, but also to learn from all of you as advisors. So if you have any topics that you would like us to cover, any conversations you think it would be helpful for us to convene, please let me know. There will be a post-event survey. Caitlin will drop the link into the chat, but it will also be emailed to you. Please provide your thoughts, or please call or email me. I'm always happy to chat. In addition to this webinar series, I did want to let you know about a few other advisor events that we will be hosting this year. We have a CAP study group, which is a study group that we host for professionals in our community who are pursuing their Chartered Advisor in Philanthropy designation with the American College. We have just kicked off our 2024 cohort, and we are already looking for candidates for our 2025 cohort. So if you're interested in being part of that cohort, please let me know. I would love to have a conversation with you and connect you with Camille Zanoni, who is currently heading up our CAP program, so you can learn more about it. A couple of other things I wanted to mention. We do have an Advisor Insights blog, which provides monthly content on some of the things that we're doing at MCF, as well as some of the frequently asked questions we receive from advisors as we work with them to assist their clients. Please keep an eye on that. We'll also post information about upcoming events on that blog. The last thing I wanted to mention is our in-person annual advisor event. We have scheduled that for September 10th at Monona Terrace. It is generously being sponsored by Reinhardt, so thank you very much, Reinhardt, for your sponsorship. We are bringing Brian Klontz in to speak on gifts of non-cash assets. You can see Dr. James smiling. I think he probably has some thoughts on the importance of that topic. It's something, if you're working with closely held business owners, you're working with people that have unique non-cash assets, it is a different process in some aspects. So we are really excited to bring Brian here. He will be here on the 10th. Watch for details on that event, and we hope you can join us. With all of that said, I did want to give one more reminder for those of you who are attorneys in Wisconsin reporting continuing legal education credit. You will be eligible for 1 credit for the live webinar series. If you're watching a replay of this, you will not be eligible for credit, but for those listening to the live stream, you will be eligible for 1.0 CLE. So every little bit helps, right? Having said all of that, I do want to take the opportunity to introduce our featured speaker. I am so incredibly excited. I sat down in December and kind of made my wish list of people who I would love to have on a webinar. And this man was definitely at the top of my list. So I'm so happy he is here today. Dr. Russell James, who needs really probably no introduction, but I will give you a little bit of background just so you know just the breadth of his scholarship and some of the really cool things he's doing in research regarding charitable giving. Dr. James is a professor in the Department of Financial Planning at Texas Tech. He directs on-campus and online graduate programs for them. He also teaches charitable gift planning at Texas Tech University School of Law. He has been published in more than 150 publications. He is doing some very groundbreaking research using some really interesting data sources, including IRS return information for nonprofits to really break down and put numbers behind some of the concepts we look at in charitable giving. And so he's doing some really exciting work. And the most important thing is he can explain all of this to us in a way that will not put us to sleep. So he is very entertaining when he talks about all this complex stuff. So I am so thrilled to have him here. Thank you for joining us. And at this point, I will turn it over to Dr. Russell James.
Okay, thanks so much. Well, I'm looking forward to sharing some of these ideas, and I think you click the stop share on your screen, and then that'll allow me to start sharing my screen. There we go. So we're going to be taking a look at these top 10 rules of charitable planning strategies for financial advisors. Now, I put this image on the screen because you have to understand that I am used to teaching people who have to listen to me. Otherwise, they get bad grades. And so I have to adjust. And so I guess for you, these might not be the top 10 rules. Just call them the top 10 suggestions or good ideas. But understand that this is what my inner teacher looks like and feels like as we go through these rules. So when we talk about charitable planning, we always want to start with making sure we've got charitable intent. Want to find out, are they already donating? Do they plan to do so? One of my favorite ways to do that is to just let folks know, hey, you can leave what you have to family, to government, or to causes that have been important in your life. Tell me what percentage you'd like to put next to each one. Now, the cool thing about asking the question this way is, number one, obviously, if they put a big zero next to charity, then you know that's not something we're going to be talking about. But they're probably going to put a number next to government that is lower than what they would experience if they don't engage your very valuable services in planning and advising. And so that can lead to those other conversations. So as I mentioned, we always want to start with establishing charitable intent. But as a lawyer, with every rule, we've always got an exception. Now, this image you see is from my favorite piece of artwork in the Museum of Modern Art. I took my daughters there in New York City, and this was the only piece of art I wanted to have my picture taken in front of. Why? Because it was part of a really cool tax law case that got to the tax court. So this is an image of Canyon by Robert Rauschenberg. It was appraised by the IRS at $65 million. It generated for the heirs $29.2 million in estate tax. Now, side note, that thing that you see there, that bird-looking thing, is not a bird-looking thing. It's actually a bird. It's an eagle that's been stuffed and stapled to the front of this piece of art. Turns out it's a felony to sell that artwork because it includes a stuffed eagle. It would also be the case for other examples like ivory, Native American artifacts. So the tax code values this not based upon the fact that it's illegal to sell, but based upon how much it would sell for if it was legal to sell. Now, it turns out that in this particular case, the IRS did win the case, but they were very reasonable and they allowed the family to retroactively donate as an estate gift this piece of artwork to the nonprofit, in this case, the Metropolitan Museum of Art. And so that would be an example where even if you have no charitable intent, you better do some charitable estate planning if you've got that kind of an asset. So let's get to some more serious practical things as we look at the top 10 rules for charitable planning for advisors. Now, the number one rule I'll start with is, of course, the most offensive rule, because I want to start out being offensive to any folks representing nonprofits here, but let me explain myself. The number one rule is never give cash. Now, why would I say something like that? Well, very simple idea. Appreciated asset gifts are objectively cheaper to give. Let's say I write an organization a check. I get a tax deduction for that. But if instead I give appreciated assets, something I've owned for more than a year, I not only get a tax deduction of the same size, I also get to avoid paying all those capital gains taxes. So let's just look at a real quick example here. And we'll just start out with the federal taxes alone. Asset gifts are cheaper first for those who are itemizers. So, let's say I give $10,000 of cash to a nonprofit. I get a deduction of $10,000. If I'm at the top tax rates, that saves me $3,700. If instead, let's say I give $10,000 of stock shares, maybe something I bought for $10 a share and now it's worth $100 a share, I not only get a tax deduction of that same size, but now I avoid paying capital gains taxes on that $9,000 of growth. That saves me $2,142 of paying capital gains taxes. So asset gifts are cheaper for itemizers. And in fact, they're way cheaper for non-itemizers. Why? Because non-itemizers can't use the deduction, but they can still avoid capital gains taxes by giving appreciated assets. Now, this idea is even more powerful in states that charge a state capital gains tax, because that state capital gains tax makes capital gains taxes more painful. So that means avoiding those taxes becomes even more desirable to do. And so here's just a quick example showing how you save even more taxes as a result of the state capital gains taxes. Now, it turns out that those state capital gains taxes became even more painful in 2018. Why? Well, because for most of your clients, they can't deduct them anymore. They're already capped out just from their property taxes on their house or real estate. And consequently, those capital gains taxes became even more painful in 2018. Now, maybe those things are going to sunset in 2025. They're scheduled to, but we'll see what happens with that. First rule is that never give cash. The second rule is pretty straightforward, and that is the idea that we take this straightforward concept of never give cash and we apply it using the charitable swap. So you might have a client, you say, hey, by the way, I noticed you're giving these gifts in cash. Do you happen to have any appreciated securities that you could give instead? And maybe the client says something like, oh, well, I've got those shares of Apple stock. They've gone up in value a lot, but market's kind of wonky right now. Not a really good time to sell. I'll do that later. Well, the response is, oh, no, you don't need to change your portfolio at all. Instead of giving the cash, you just give those old shares of stock to the charity. You use the cash to immediately purchase brand new shares of Apple stock. You don't change your portfolio at all, but because those shares are brand new, you've wiped out all the capital gain from your portfolio. Now, by the way, there is no wash sale rule for this that would otherwise require us to wait for a month before we repurchase those shares, because this is gain property, not lost property. You never donate lost property. You sell it, take the valuable tax loss, and then you give something else. So the point is that we can do this charitable swap without changing the portfolio. It's almost like a free tax benefit we give up every time we give cash instead of appreciated assets. We take the opportunity to just wipe that capital gain out of the portfolio. So if we ever need to sell, or if the estate tax law changes and we don't get that stepped up basis, we're already prepared for that. By the way, one of the most convenient ways to do this these days is to use a donor advised fund. That is, you take that appreciated asset, ship it to the donor advised fund. The fund sells it, and then the cash can go out to various organizations. Now, the cool thing is there are donor advised funds that can work with any kind of valuable asset. Start with your community foundation. If it's too weird for them, they can get you in contact with groups like, as was just mentioned, Allison talked about Brian Klontz coming up to speak. He's got an organization that deals with weird assets in a DAF. There's always ways that you can manage through a DAF so that the organization just gets cash out the other side. So that's the second suggestion, to use the charitable swap. The third suggestion, you probably heard this one before, but that's to learn bunching and some other new tricks that I bet you haven't heard of. So what is bunching? Well, for non-itemizers, we want to consider bunching donations into a big giving year. So let's suppose we've got somebody that as a single individual, they've got a standard deduction that's about $14,000. If they give $10,000 a year, they can never use those deductions because they're always under the standard deduction. And so they're just going to choose the standard deduction. If they've got some financial flexibility, what we say is go ahead and pre-fund all 4 years of your charitable giving at once by putting that money into a donor advised fund. So in year one, we have a $40,000 transfer to the donor advised fund. And then in each year, we send out $10,000 from that fund to the various charitable causes. Well, the cool thing is that means we can use a big part of that charitable gift deduction in year one because 40,000 is more than 14,000. And then in years 2, 3, and 4, we just take the standard deduction. But of course, if we're going to be shipping money into a donor advised fund, well, we don't want to break our first rule of never give cash. So let's go ahead and ship an appreciated asset into that donor advised fund. And in fact, we can even do the charitable swap and keep the portfolio the same and just send those appreciated asset gifts into the fund. So the notion here is this is just a charitable swap using that donor advised fund. But if we've got financial flexibility, let's push that all into that first year. Now, by the way, when 2018 came, a lot of people felt like, well, this is going to be really negative for charitable giving because fewer people are itemizing. But actually, there were massive benefits for charitable giving that went up in 2018. So, for example, if you went back to 2017, there was this thing called the P's limitation that wiped out up to 80% of the charitable deductions for our high income clients. That disappeared in 2018. And also in 2018, we had higher state tax benefits because those state taxes became more painful. So that made the charitable deductions, both income and capital gains, more powerful. We also got an increase in the share of your income that you could wipe out with charitable giving. By the way, some people look at this and say, well, what is this? Am I advising Buddhist monks that are giving away all of their income? No, no, no. This is for high net worth clients. Why? Because their reportable income is going to be relatively low compared to their wealth. And when they give even a reasonable or modest share of their wealth, it's going to swamp their income. And so this was a high wealth client benefit. Above the line small gift deductions, we did have those in 2020 and 2021. Those dropped in 2022. By the way, I know any of you that follow the latest Giving USA, there's been a lot of hand wringing over the decline in small gifts or donors that are less likely to be giving at all. And a lot of sociological rumination on that. It's frankly just tax policy. And that's because the Giving USA 2023 is predicting giving in 2022, which was the first year we had after that above the line deduction drop. Now, why am I talking about all these 2018 things? Because everything old is new again. All of these things are set to drop after 2025, and so because of that, then we want to keep these things in mind that they may be coming back. By the way, speaking of one of the 2018 provisions, here's a wonky little thing you can do if you happen to have a client who qualifies for this qualified business income tax deduction. Do keep in mind that it is a very weird deduction in this aspect. It is the only thing in our tax code, as far as benefits go, that phase out at different higher levels of taxable income. Everything else is phases out using some variation of adjusted gross income. This is different. Now, why do we care about that? Well, taxable income is, among other things, what you have left after you take your charitable deduction. What does that mean? If you've got a client who otherwise qualified for that 20% business income qualified business income deduction, but because they made too much, they have phased themselves either partially or entirely out of this deduction, that's a good year to target the charitable giving, because with that charitable giving in that year, they not only get the initial value of the deduction, but they get to also phase themselves right back into that qualified business income deduction. So keep in mind that this is an opportunity for a double benefit. If you've got somebody who has charitable interest, just stuff a bunch of money into their donor advised fund, pre-fund the next many years worth of charitable giving, and take that deduction in a year when you can get that double bonus. Again, something we can do right now. Who knows? This deduction might go away like a bunch of other things that might go away after 2025. So we want to learn about bunching and some other new tricks. The next suggestion is to give retirement RMD first and then to give more at the end of life. Now, you probably already know this, but if we're looking at any retirement account, we've got three stages of the account. Early stage, early distribution before age 59 and a half. We don't want to do that normally because unless it's for a qualified reason, we got to pay a 10% penalty on that. Regular distributions between age 59 and a half and 73, we can take it out if we feel like it, just have to pay income taxes on it. And then once we hit age 73, we've got that required minimum distribution. You got to start taking it out whether you want to or not. Now, once a person hits that age of 73, where they have to take out those required minimum distributions, otherwise they got to pay a 25% penalty, they could take that distribution, turn around, and make a gift with it. That can sometimes, in a perfect world, offset, but often it doesn't. And that's because they have to be itemizing. There have to be no income giving limitations, no negative effects from the increased AGI. Even Medicare payments can go up from that. Part D can go up from that increased AGI. Not in the wrong state. Lots of other issues involved. So what do we want to do? We want to do the qualified charitable distribution. That's where we ship the money directly from that IRA or IRA rollover into the charity. We can start doing that. We don't have to wait till age 73. We can start doing that at age 70 and a half. So that age hasn't changed. This is money that the client has never paid income taxes on, and now they never will if they decide to do their charitable giving that way. A few things to keep in mind about this. This is for IRAs or IRA rollovers only. So if you got a 401k, 403b, SEP simple, something else, you convert that first into the IRA rollover. Then you can do the qualified charitable distribution. This is limited to $105,000 per person maximum. That is now an inflation adjusting number. That's why it's no longer 100,000. This year it's 105,000, and we have to ship it to a real live charity. That is no donor advised funds, except for special purpose donor advised funds that your community foundation can talk to you about, but normal ones you can't do. And no private foundations. We also have a special new rule now that if folks were taking above the line deductions after 70 and a half, that can reduce their ability to do this until those are burned through. Do keep in mind that it is often very tax advantageous to give beyond or even without a required minimum distribution. Remember, income taxes are going to have to be paid on that money unless we do a transfer like this. Qualified charitable distribution is more efficient than a tax deduction, and it's way more efficient than if you have a client who's making gifts and not taking those deductions. That is very tax inefficient. So if we have a client 70 and a half or older, we want to make sure they're using this tax advantage giving up to $105,000 a year. Now, look, I'm a professor, so I love to give exams. We'll see if you can pass this first one. How much can a donor age 70 and a half transfer through the QCD? What if their required minimum distribution is only $25,000? Doesn't matter. It's $105,000. What if they haven't hit age 73? They've got no required minimum distribution. Doesn't matter. It's $105,000. What if their RMD is $2 million? Doesn't matter. It's $105,000 as the amount you can transfer by this. By the way, one little thing to keep in mind, as I mentioned, you must first convert other plans into an IRA rollover before you do this. But bit of a warning, any RMD in the year of conversion must be paid out. The QCD can't fix that for that year of conversion. That's because you've actually got to pay it out as part of the conversion process before it lands in the IRA rollover. So the solution is very simple. Just convert that account before your first year of required minimum distribution. Remember, they can start using this when they are 70 and a half. So if you have charitable clients, go ahead and make this conversion process in advance so you can sidestep getting hit with that RMD for the first year. Hey, we did get a new animal last year that was we could do a transfer as a qualified charitable distribution to a charitable gift annuity. You can do up to a one-time transfer, lifetime single opportunity of $53,000. The entire amount counts towards RMD. Now, you then transfer that to the charity, and the charity gives back the person lifetime income. This can be payable only to the participant and the participant's spouse. It cannot be assignable. 100% of all of those checks are taxable, and there must be a 5% minimum payout. Now, I'm not saying you're going to run into a lot of clients that need this because they're saying, I don't want the RMD, I don't need the income. And we say, how about some lifetime income? Well, maybe that won't always fit, but it is an option. Do beware of some of the traps. We can't use the standard gift annuity documents for this because it has to be non-assignable. They can't even assign it back to the charity, even if they don't want that income. Not allowed. They got to take that income, pay the taxes on it. There is required to have a 5% minimum payout. The ACGA rate sometimes suggests lower than this, but you got to ignore that. It's got to be 5%. It does still have to be charitable at 10% or more present value. Otherwise, it doesn't qualify as a gift annuity. And this has to be a completely separate gift annuity. No joint funding, combination, later additions, etc. A few other issues. I don't know if nonprofits necessarily want to market this. I would say just spend your time talking about the qualified charitable distribution. Occasionally, you might have a gift annuity request at an odd amount where somebody's trying to exactly match their required minimum distribution. And yes, technically, you can send this not to a gift annuity, but you could choose to send it to a separately drafted, separately constructed charitable remainder trust. But that's nonsense. Nobody's actually going to set up a charitable remainder trust for $50,000 of transfer. Way too many administrative hassle and costs to deal with that. One last really wonky thing, and that is the Secure Act created the opportunity, if you have a couple that is sharing financial resources, for something like an above the line deduction. So what do I mean by that? Well, let's suppose you have the wife who has $7,000 of earned income. If that person turns around and makes a gift, this may result in an unusable itemized deduction. But that the wife can take that $7,000 of earned income, put it into her IRA, and then the spouse could take $7,000 out of his IRA and send that through a qualified charitable distribution to the charity. Now, one person can't do this. One person can't simultaneously take the above the line deduction for stuffing money into an IRA and do the qualified charitable distribution to pull money out of that IRA. But two people together, they can do this. You can have a QCD spouse taking it out and an earned income spouse putting it in. So just keep in mind that this is something that is possible to do if you have somebody in that situation and they're not actually they don't want to increase the amount they've got in their IRA. This allows them to not increase the combined amount, but to still take that above the line deduction. Hey, one of the things to keep in mind is that retirement plan assets inherited by non-charitable beneficiaries are going to be reduced by income taxes. This is true regardless of the size of the estate. A lot of times people think, oh, I don't have that really large estate size. I don't have to worry about taxes. Well, you don't have to worry about estate taxes, but you sure enough do have to worry about income taxes. Let's take a real quick example. Let's say you have a client only has two assets, $1 million IRA and $1 million house. They want to leave half to a child and half to a charity. Doesn't matter which goes where. It does, and to an extreme degree. Let's look at what happens if we do it the wrong way. On the left-hand side, we're going to send that house to the charity, but we're going to send the qualified plan money, the IRA or 401k, to the child. Now, to make this a really sad story, let's force the child to live in the state of California and to pay the top state and federal tax rates. You know what happens? That $1 million IRA, it just turned into $497,000 when the child pulls it out. So this is a serious tax issue. Now, let's flip it around and do it the right way. Let's send the qualified plan money to the charity. That $1 million IRA, hey, it stays the full $1 million. Charity is an exempt organization. It doesn't have to pay any of that. And we send the other assets to the child. So do keep this in mind, especially because the Secure Act now requires a faster withdrawal. We know that the Secure Act requires all of it to be withdrawn within 10 years, and the IRS seems to think that it requires withdrawal to start right away in year one. We don't have a final answer on that one. The IRS is holding that it requires immediate withdrawal, but they're giving a little bit of grace at the moment where they're not penalizing folks, but we don't know. But the point is, it's going to have to come out. It's going to have to come out pretty fast, and those taxes will have to be paid. By the way, if you've got a client who is charitably inclined in their estate giving, and they want to stretch this out, so you don't have to start pulling it out right away, don't have to start paying those income taxes. We can actually stretch that out by naming the beneficiary of that qualified plan to be a charitable remainder trust. Now, we'll talk about charitable remainder trusts in just a moment, but the idea is that those are going to pay for the lifetime, or up to 20 years, whatever you pick, for the lifetime of that beneficiary. So you can really stretch out those payments, and you can also then continue that tax deferral because there's no taxes on anything inside a charitable remainder trust. So some good retirement plan charitable beneficiaries. You can do a public charity, you can do a private family foundation, you can do a charitable remainder trust. A quick side note, don't name a charitable lead trust as a death beneficiary because they are not tax exempt entities. And also, just be careful if you're going to name the estate as the beneficiary and put in with instructions in the estate documents. If you don't get this phrasing exactly right in the estate documents, then the estate itself is going to have to pay those income taxes. Not saying it's not that it's impossible. Just make sure you've got sophisticated counsel if you're trying to do it that way. Speaking of where we have a lack of sophistication, sometimes you will get, if not an advisor, maybe somebody at an organization or a bank who is saying, oh, we shouldn't put the charity on the qualified plan because the charity is not a designated beneficiary, and this could accelerate the RMDs for other beneficiaries. Folks, this is a problem that has so many solutions that it's not a problem at all. We literally don't care about this issue. Why? Well, let me give you some of the solutions. Oh, I don't know. You could just pay out the charity their share. If you do that before September 30th of the year following the year of the participant's death, you don't have this issue at all. And the nonprofits are never going to want to leave that money inside that account. So just ship it out. There's other things you could do. The beneficiaries could separate the accounts by the end of the year following the participant's death. If for some reason they didn't want to pay out the charity their share, if it's a spouse beneficiary, you could simply roll that share into the spouse's IRA. Or if you want to get really creative, you could go ahead and separate those IRAs or qualified plans into one that has 100% charitable beneficiary and the other that is 100% non-charitable. And then you could pick and choose your required minimum distributions where you want to take those from. But just keep that in mind. It's a problem. It's not a problem. So that was the fourth suggestion. The fifth suggestion is to take deductions today for transfers that don't actually land until tomorrow. And I'll start with the simplest, but maybe one you haven't heard of version of this, and that is the retained life estate deed. What is that deed? It can give the inheritance rights to a charity. Unlike a will, a retained life estate deed is not revocable. Once you record that, it is a gift of those inheritance rights, and you can't change your mind. It's super simple. We can't do this by trust or contract. We just do it on a deed. We just change that deed from John A. Donor to John A. Donor for life, for remainder to whatever your nonprofit organization is. Except for the tax filings, that's all you got to do to make this transfer. Donating inheritance rights to personal residences or farmland with this kind of a deed creates an immediate charitable income tax deduction, even though, of course, we've only donated the inheritance rights. By the way, this even includes second homes. It's just a personal residence, not the primary residence necessarily, vacation homes, even a boat with bathroom, cooking, and sleeping facilities, as long as it's occasionally used by the donor as a residence. Now, we can get a pretty big deduction for this kind of a gift, but it is interest rate sensitive. So you can see how if, let's say we've got an age 55 donor who is transferring the inheritance rights of $1 million of farmland, you can see how the size of that tax deduction depends upon the current interest rates. We've had an increase in interest rates, so that deduction is less than it was, but it's still a pretty big honking deduction. And if you've got somebody who wants to do this, this is a very powerful way to get an immediate income tax deduction. Of course, our rates have been going up. As interest rates rise, you can use either of the prior 2-month rates to lock in the bigger deduction. The trade-off is this: you do it by will, no income tax deduction if you're leaving that inheritance to charity by will, but you can change your mind. You do it by deed, you can't change your mind, but you get an immediate income tax deduction. It also immediately increases the donor's available cash or assets under management by massively lowering their taxes because of this giant deduction that they can use this year or in addition the 5 following years. Charitable remainder trust. I mentioned those earlier. That's another way where we can get an immediate tax deduction, even though their transfer to charity doesn't happen until the end of life. We put that asset into the charitable remainder trust, and it grows with no income taxes, no capital gains taxes inside the trust. The only thing we pay taxes on, just like a traditional IRA, is what we take out of the trust, the payments during life. We get a big upfront income tax deduction for making that transfer in, even though it doesn't go to the charity until the end of life. Speaking of these trusts, one way that you can get an immediate tax deduction for tomorrow's charitable transfers is through a grantor charitable lead trust. How does this work? Well, you have a donor, takes an asset, they put it into a trust. That trust then backs up the promise to give, let's say for the next 10 or 20 years, a certain amount of money to the charitable organization. Why do we do that? Well, number one, we can take the immediate income tax deduction for all 10 or 20 years worth of that giving. Now, once again, the amount of the deduction that we can take is interest rate sensitive, and you can see how that works in this example. But the notion of this is that we can put that asset in to fund this, and then at the end, we can get that asset back. That's why you might want to do this and not a donor advised fund, because you put it into a donor advised fund, you do get 100% deduction, but you're never going to get that asset back. If you want the asset back, here's a way that you can pull forward those deductions if you happen to have a year where you're targeting getting that higher amount of deductions. There's one attorney at iclat.net that does a high volume of these at relatively low cost. So it's a good connection there if you have clients interested in that. So that's the 5th suggestion: to take deductions today for transfers tomorrow. The 6th suggestion is to match deductions with Roth conversions. Now, Roth conversions and sophisticated charitable planning work great together because they help match up income and deductions. So what is a Roth conversion? Well, let's say we've got $1 million in a standard IRA. Anything we pull out of that is taxable. If we then convert that, use a Roth conversion, convert that into a Roth IRA. The cool part is everything we take out of that Roth IRA is tax-free. Not just the $1 million we put in, but all of the growth in the future on that $1 million. When we pull that out, we pull it out tax-free. That's why we love the Roth conversion. There's a downside though, and that is you put $1 million into that Roth conversion, you've got $1 million in income. And we don't want that to be taxable income. So what do we do when we have to recognize that income? We need some offsetting deductions if we're going to do that Roth conversion. Hey, where do we find those big honking offsetting deductions? That's what we get from sophisticated charitable planning. That charitable remainder trust I just mentioned, great big tax deduction. That grantor charitable lead trust I just mentioned, great big upfront tax deduction. Also, donor advised funds, charitable gift annuities, private foundations, or of course, the remainder interest deed or retained life estate deed in a residence or farmland. So the point is, we get a target year, we want to pull in those deductions. A Roth conversion might make this a target year. Other things can too. If we get a big temporary spike in income, make this a target year. That makes it the year to do this kind of sophisticated charitable planning, to pull forward those charitable deductions into right now when we need them. Now let's flip this around. Charitable deductions, of course, can be limited with an additional 5-year carryover to 20, 30, 50, or even 60% of income, depending upon the gift and the recipient. Now, the challenge is, especially if you have clients who have high net worth, when they make gifts that share part of that worth, it's going to tend to swamp their income. What does that mean? That means they're going to have unused charitable deductions. Oftentimes, for high net worth clients, unused even through that 5-year carryover. Well, if those deductions are just going to die, if they're going to be unused, maybe we want to pull future income into a current year so that we can use more of those deductions. And what's the only smart way to pull future income into a current year? You guessed it, it's the Roth conversion. So again, it's this notion that the Roth conversion and charitable planning can work together to help balance those income and deductions. So that's the 6th suggestion, to match deductions with Roth conversions. The 7th suggestion is this one, that is to buy life insurance with the tax deductions. Charitable planning devices like gift annuities, retained life estate deeds in homes and farmland, charitable remainder trust, they can produce amazing tax advantages. They can reduce income taxes, capital gains taxes, and estate taxes. But you're eventually going to transfer something to charity at the end, right? That means they can also reduce the heir's inheritance. Now, if this is a concern for your client, life insurance can help to offset that. If we're in an estate tax situation, we can use the irrevocable life insurance trust to make that estate tax-free life insurance. Now, we can do this even without sophisticated planning. Let's suppose we've got John, age 65. He's at that 37% federal income tax rate, owns $100,000 of farmland. He'd like to use it for the rest of his life, then leave it to charity, but he also wants to benefit his heirs. How can we do that in the simplest way? Well, we can just write that deed that donates those inheritance rights to charity. He gets a great big upfront income tax deduction. He can then take the value of the money he's not sending to the IRS because of that income tax deduction, and he can use it to buy life insurance so that the heirs who aren't going to be getting this farmland now instead get the life insurance. We can get more sophisticated, do it through a charitable remainder trust with wealth replacement life insurance. Here's a simple version of it with the simple transaction. So that's the 7th suggestion, to buy life insurance with tax deductions. The 8th suggestion is something that becomes very powerful, and that is to earn more by avoiding capital gains taxes. So a client holds, let's say, a large, highly appreciated asset, and it may generate little income, like developable land, maybe it's non-dividend paying stock. And the question comes up, how can she convert it to income generating property? Well, we could take the traditional approach and just sell it, pay the capital gains taxes, and try to earn income on whatever's left over. Now, just at the federal level, that's going to take that $1 million asset and often convert it to a $762,000 asset. If we got to pay capital gains taxes at the state level, it gets even smaller. A smarter way to do that is to transfer it first into a charitable remainder trust. If we put that asset into the trust basket first, we sell it, no upfront capital gains taxes. That means that $1 million asset, after we sell it, what do we have left? We still have the full $1 million left. We don't pay any upfront taxes. We've still got the full $1 million left to invest. This can be powerful. Let's look at a simple example. So Priscilla wants to sell $1 million non-income producing, let's just call it a zero basis asset. And then she wants to spend the interest income of 5% while leaving principal for her heirs. We're just going to put her at the top federal tax rates for this example. And notice the two different approaches. On the left-hand side, we do it in the traditional way. We sell the asset, that $1 million asset, boom, it's now a $762,000 asset. She's earning 5% on that, so she gets $38,100 a year. That's $762,000. That's what's left over at the end of life because she just uses the 5%, not the principal. But if she's in a taxable situation, then the heirs are only going to net $457,000. Now let's look at the right-hand side. Let's instead first put that asset inside a charitable remainder trust. What happens to the $1 million asset when we sell it? It's still a $1 million asset. And it's in a trust that's going to pay 5% a year to Priscilla. Now, by the way, not only does that $1 million stay entirely intact, but we actually get an immediate upfront big charitable tax deduction as a result of putting that asset into the charitable remainder trust. So we're earning more because we get $50,000 a year, not the $38,100 a year we would get if we sold it, got it knocked down by capital gains taxes before we invest it. So we get a larger amount each year, and we get a big upfront charitable tax deduction. Let's say it's $300,000, so it'll be worth about $111,000 in money we're not sending to the IRS. Well, here's the thing. When you're getting that much more income, $50,000 a year versus $38,000, and you get this big upfront tax deduction worth more than $100,000, what can you do with all of that excess? You can buy life insurance with it, right? So let's go ahead and set that life insurance up into an irrevocable life insurance trust. And we can fund life insurance that's going to, both with the upfront value of the tax deduction and with the annual increase in income, we can fund that life insurance policy that's going to pay tax-free to the heirs about the same amount they were going to get after tax in the other scenario. So what have you done? Clients has just as much income, maybe even a little more, even counting the amount that they're using to pay that life insurance policy. The charity, a full $1 million gift ends up going to the charity. And where did that come from? It really came from tax planning magic, right? It's just the notion that we're stacking up all of these tax benefits, creating this great charitable distribution at the end where the heirs are essentially left intact. So that's the 8th suggestion, to earn more by avoiding capital gains taxes. The 9th suggestion is growing tax-free. Now, all of these kinds of instruments create these wonderful tax-free growth environments. Growth inside a donor advised fund, of course, is tax-free. Growth inside a charitable remainder trust is tax-free. Works just like a traditional IRA. Only the distributions are taxed. Growth inside a private family foundation is almost tax-free. There's a 1.39% excise tax. So that's about the smallest tax you're ever going to run into with wealth management. And now, one of the things that we're a little uncertain of right now is that we do know that assets under management fees are allowed inside charitable remainder trusts, and they are allowed inside private family foundations. But now with the IRS latest proposals, we might soon have to change that rule for donor advised funds. If that changes, what that means is if you are managing funds for clients, you may not be able to pull those AUM fees directly from the donor advised fund account. Instead, you would actually have to pull your AUM fees from the taxable accounts. for both your taxable account and for your donor advised fund account that you're managing. So you may have to do that shift depending upon where all this lands. We've just got some proposed rules from the IRS now. We don't know where that thing's going to land, but it has created a bit of higgledy-piggledy in this space right now, trying to figure out if we can continue to take AUM fees directly from the DAF, or if we're going to have to take those AUM fees from the taxable accounts of the client instead. Hey, one of the reasons why these tax-free growth environments are so powerful is, probably don't need to tell you, but if you can grow tax-free, you grow a whole lot faster. And so over the years, that is going to be a much faster rate of growth. A charitable remainder trust increases the client's assets. It also increases assets under management because, oh, by the way, those AUM fees are fine for charitable remainder trust. There's no question or concern about that. There is just only the concern about the donor advised funds at the moment. So the charitable remainder trust increases both assets and assets under management. Remember, there's no upfront capital gains tax at the sale. We have tax deferred growth for all the way during the client's life. Only the distributions are taxed. We get an immediate upfront tax deduction, and as an advisor, you can continue post-mortem management by the family with the distribution going to a private family foundation or perhaps a donor advised fund. Now, the interesting part is that there are so many tax benefits that stack up and up for these kind of accounts. It led one finance professor to ask this question. If you have a maximum payout charitable remainder unit trust with appreciated assets, does it make more sense, even if you got somebody who's not charitably inclined, for them to put that asset into the charitable remainder trust and get that higher income and all those tax benefits versus just sell it in a taxable account, invest it, and take that investment? So here's what he did a Monte Carlo simulation of 3 million retirement lifetimes of an age 60 and 55 female, varied the lifespan returns, varied the market returns, set a target for this is how much we're going to spend in retirement, used a 20% basis asset. And what was the result? The result was it was more beneficial to use the charitable remainder trust. It was less likely to fail than a direct investment, and it failed in a much better way. If your plan fails with a direct investment, that means you go to zero, you're broke. If your plan fails in a charitable remainder unit trust, it never goes to zero. It just has a payout that becomes less than your target amount. So you end up with clients who on average get to consume more. And believe it or not, the heirs even wind up better. Why? Not because we're buying life insurance in this case, but just because if the clients only consume their target amount, there is so much more income that's created that the heirs end up inheriting, on average, quite a bit more. So yes, even for somebody who wasn't charitably inclined, those tax benefits stacked up to be worth more than just doing normal sale, pay the tax, and invest. The 10th suggestion is to maintain wealth over multiple generations. Folks, keeping wealth together for many generations is pretty hard to do. As we all know, the government takes a big old chunk of the assets at every generation. The rest gets then divided into tiny little pools at each generation for each beneficiary. The government then takes a chunk of all the subsequent earnings, and at some point, you're going to have a greedy spendthrift heir. One of the things to consider is the power of a private family foundation or a donor advised fund, or many of the hybrid funds that community foundations can offer in this context that holds those funds and distributes charitable grants. Now, this can allow for multi-generational management of those funds. Obviously, we've looked at the problems with inheritance. It breaks up into a bunch of tiny little funds. You don't want to deal with them. Got spendthrift heirs, all of those issues. If we're looking at private foundation or variations of the donor advised fund, we've got a big pool of assets, no division. no division is going to be happening at each generation. No estate taxes, no capital gains taxes, no or almost no income taxes, 1.39% with the private foundation. And you get this family management, which can be very influential. I do need to point out there are some things that you can do with a private foundation that you can't do with a donor advised fund. We know, of course, you can take assets under management fees with the private family foundation, but there's just some question as to whether the IRS is going to allow that for the little people, right, with the donor advised fund. There's also some other things you can do with the private family foundation. You can hire an insider to perform necessary professional or managerial services if compensation is reasonable. That means you can hire family members for investment advice, legal work, accounting, tax services, banking, and administrative assistance. Some things you can do with a private foundation you can't do with a DAF. You can reimburse reasonable and necessary expenses such as meals and travel to foundation board meetings for board members, also travel for junior board members who perform some function in that role. What's a junior board member? That's the grandkids or the great grandkids, right? That they're minors, but they're being trained to be future board members, so we can pay for the reasonable and necessary expenses of meals and travel. Travel to grantees or potential grantee sites as well to investigate current or potential awards. Private foundations allow for unlimited, multi-generational, nearly tax-free control of wealth with the ongoing ability to provide insider travel and employment for professional management services, limiting charitable activities to the founder's desires. One of the things to keep in mind, got donor advised funds. They are much cheaper, much quicker, much easier to set up, but they're legislatively newer. And boy, did we just learn that a few months ago when the IRS decided, hey, we have different rules for these. You can't do the private foundation stuff when it comes to assets under management. Private foundations way more legislatively stable. One other example, and I'll end with this example, and that is a purely estate tax planning device, and this is the non-grantor charitable lead trust. Again, the idea is the donor puts that asset into the trust basket. It pays out to a charity for the 10 or 20 years, whatever you set it up for. Anything left over at the end does not come back to the donor. Instead, it goes to the donor's heirs. Why on earth would you ever want to do that? Folks, it's purely a tax avoidance mechanism. Why is it a tax avoidance mechanism? Well, the gift taxes you pay on the present value of what is projected to go to the heirs. You don't pay anything on what actually goes to the heirs. So if that actual amount is higher than the projected amount, that part goes to the heirs tax-free. If that projected remainder, that projected remainder is going to use the initial Section 7520 rate. If the actual growth can beat that Section 7520 rate, then the actual remainder will be greater than the projected amount. Now, the way that we set this up is always the same. We project that the amount left at the end is going to be $0 or $1. So everything is projected to go to the charity. That means no upfront gift taxes, no taxes if we beat that rate and we end up transferring some to the heirs at the end. So that's where we get the power from. If we don't beat that rate, it still all pays out to charity. It's just that, okay, well, we didn't pay any gift taxes anyway. We took a gamble, but it wasn't really a gamble because there's no downside to the gamble if you were planning to make those charitable transfers anyway. So for example, the projected remainder let's say you put a $10 million asset into that. Let's say that Section 7520 rates, let's say they're 4%. That's going to zero out at about a $761,000 annual transfer over 20 years. That means if you put $10 million in there at a 4% rate, it's projected to be $0 at the end of 20 years. If you're paying out $761,000. Or you can see here, back when we had the very low rates, you can see those numbers were a little bit different. But it doesn't really matter how low the rates are. It matters how big the delta is, the difference between the Section 7520 rate and what you're actually going to earn. So for example, if the 75/20 rate is 4%, but you earn 10%, that's $23 million that gets transferred to the heirs tax-free. If the Section 75/20 rate was 0.4%, like it used to be, and you earn 8%, $23 million gets transferred to the heirs tax-free. The point is, if you've got a charitable gift that's already planned or a charitable bequest that's already planned, the zeroed out CLAT or the zeroed out testamentary CLAT, it's a no cost chance of tax-free transfers to family members. And frankly, in an estate plan, it's a lot smarter way to transfer anything to family members because it gives them more than one shot at the inheritance. They get some at the end of life, but some 10 years later, some 20 years later, some even further than that. And that then gives them more opportunities. If they blow it the first time, they get it the second and third time. So very smart tax planning if you're in an estate taxable situation. Don't have too many clients in that situation, but if those exemption levels sunset after 2025, you may have more clients that care about these things. Well, folks, I teach 2 semester-long courses on this topic, and so I could go on and on about all the cool strategies you can use to preserve wealth. We could talk about lifetime and testamentary transfers to private foundations, CRT spigot trusts that pay to life, and then to the family foundations, zeroed out CLATs that pay charitable interest to family foundations with excess growth growing to the children, and on and on. But I have officially gotten you through all of your required minutes for the CLE. I do want to leave an opportunity if there are questions, comments along the way. I do notice that Joanna asked about, are you receiving the slide deck? The answer with all of my stuff is always yes. I share all of my stuff for free. Happy to send this slide deck to the Community Foundation. They can ship it out. Or if you want to connect with me on LinkedIn, I'll actually send you links to everything I've ever done, including free links to the digital version of Visual Plan Giving, my video series on YouTube that goes through all the world of plan giving, plus all my other books, slide sets, even the law review articles that nobody ever wants to read. I'm going to send you links to those as well. Just an inappropriately long response to you connecting with me on LinkedIn. But if you want it all for free, do that. Or if you're not on LinkedIn, you can just send me an email. It's just a little bit easier for me to keep track of things on LinkedIn. So I'm going to go ahead and stop it there and see if there are any additional comments, questions, snide remarks, whatever comes to mind, things you're thinking about on charitable planning.
While we're waiting for those, can I ask you one follow-up question? I think that we get
please
every
do.
once in a while for people as we're having conversations. So obviously establishing a family foundation can be a great idea multi-generationally. In some cases, if a lot of funds are spent out throughout generations, the foundation may reach a point as far as assets where the admin involved with administering it and things like that is just kind of cost prohibitive. So
Exactly.
one of the questions I get a lot is, does it make sense for a DAF to be a succession plan for a private foundation?
Yeah, and that's oftentimes whenever the private foundation gets to the point where the benefits are outweighing the costs, that is almost universally what is done with it. You go ahead and ship all those assets into the DAF, unless you've got some charitable cause that you say, okay, well, let's just send it to the cause right now. But if you want the flexibility to decide that later, then just close it out, ship it into a DAF, and then you can't get any benefits from it now, right? You can do these kind of insider benefits for a private foundation, but also you don't have all that administrative cost. And that's, I think, almost universally the strategy of whenever that private foundation becomes too much of a hassle, as more hassle than it's worth, that's when you just say, let's just pay it out to a DAF and keep it simple at that point. No doubt, administering the DAF for the account advisor is way simpler than managing the private foundation.
Well, I don't see any questions. I see somebody expressing their extreme gratitude to you, and I would like to do that as well. This has been fabulous and so incredibly helpful. Like Dr. James said, if you want to connect with him on LinkedIn, I can attest to the ability that if you send him a message, you get a very detailed laundry list of things, and he is very attentive to his LinkedIn. So he's great to connect with that way. Before we hop off, I just do want to thank you again, Dr. James, for spending this hour with us. And I'm just going to share my screen and remind you of a couple of final items. So we will be sending a survey after this program. Please, please, please complete it. That tells me what you want to hear more about, and helps me make the case to bring great people like Dr. James to us to have these conversations. We have two events coming up, as I mentioned. So we have our May webinar scheduled on May 23rd. More people from my wish list. We have Jennifer Ridley Hansen and Jessica Schwantes speaking to us on educating clients on charitable giving options. So that is coming up at noon on May 23rd. Your follow-up email for this webinar will contain a link to register. So if you are so excited about this one and you want to make sure you're on the list for the next one, go ahead, look for that email and follow the link. As I mentioned, we do have our in-person event coming up on September 10th at Monona Terrace featuring Brian Klontz. Keep an eye on our blog. Keep an eye on our LinkedIn for non-advisor webinars. And then if there's anything I can do to be of assistance, any topics you want to hear from, any people that you think would be helpful to us in elevating the conversation around giving in Madison, please reach out to me. I've included all of my contact information here. Again, just to wrap things up, thank you so much, Dr. James, for spending this hour with us. It's been incredibly helpful, and we look forward to having more conversations with advisors going forward. So thank you all for attending and have a great day.
Thanks, everybody.